Hi, welcome back. The other day, we reviewed some basics of portfolio allocation and risk management. And before I jump in today, I just want to say why it's important, why I'm doing these videos. The stock market is a vehicle to generate income, and certainly for the uber wealthy, it might represent something different. But for people watching this, you may well be invested in the market through a 401k or an IRA, or maybe if you inherited a little bit of money, saved some money. I've seen comments on Facebook, not in my threads, but just out there, that say things like, well, people are out of work and running out of money, but the stock market will come back. Whoop-de-doo. And that's obviously very cynical, and I understand that. It can feel like the financial system is geared only toward the wealthy, and you know what? There's a point to that. They have ways of leveraging the market that most of us can't, but the stock market is also a mechanism where the rest of us can generate income and grow our wealth, but contrary to what you've been told for years by traditional financial planners, it's not the only way. And I'll be saying a lot more about that over time, but I wanted to let you know, I understand if you feel like the market is very distant from how you're feeling right now. But if you have money in the market, this is important information for you to understand now and into the future. So let's jump in. So if you're close to retiring or already in retirement, you might have what's called a very conservative allocation of 25% stocks, 75% bonds. And we're looking at a portfolio right here that already bakes in that 25-75 allocation. It's the DFA Global Allocation 25-75 portfolio. And the intent of this, and this is just one easy example of how you can do it, is to provide some income from the interest you receive from owning bonds. And that's actually some comfort during a time like this, or really during any type of market, where you need consistently generated income from your investments. Bonds are also much less volatile than stocks, and frequently, though not always, they move up when stocks are moving down. So bonds can serve as a buffer against stocks' inherent volatility. So how has this 25-75 portfolio done so far in 2020 versus the S&P 500? Let's take a look at the chart. Here's how it charts against the S&P 500, which, if you recall, is the index of big U.S. stocks, so it's inherently much more risky than a portfolio that holds bonds and other asset classes. Now, the fund itself, the DFA 25-75, has declined 4% year to date versus the S&P 500, which is down 13.65% year to date. Now, sure, they both show losses, but don't you want to dig yourself out of a smaller loss rather than a bigger loss? One of the biggest issues during a downturn is having to sell assets at a loss to raise cash. So say you're a retiree and you need the money to pay your monthly living expenses. Do you want to be withdrawing from stocks right now, which have tumbled and are worth less than they were a few months ago? Or maybe have some money in cash or bonds that have held their value more? Now, I think that answer is pretty obvious, and I actually just wrote an article about that concept for U.S. News and World Report. Hasn't been published yet, but I will come back and talk about that some more in another video after that's published. So that's all I've got for you today. Please let me know if you have questions about the market or your personal finances. Thank you so much for watching. I appreciate you, and I will be back soon.